Okay, good afternoon and welcome to Impact Capital Forum's webinar series. Today we have a very exciting local topic where we put a lens on CDFIs and other lenders working with, and impact investors working with social enterprises in the New York City area, trying to keep both small businesses and communities sustaining themselves during the time of the pandemic. Impact Capital Forum provides a platform for education, collaboration, and thought leadership in the areas of impact investing, social enterprise, and microfinance. We've been doing this for about 15 years now in terms of in-person events, largely in the New York area, and have just started our webinar series. There's actually another 4 or 5 webinars listed coming up in the coming weeks, and we encourage you to have a look at impactcapitalforum.org to see what they are. They include topics like financial literacy. We just finished Financial Literacy Month, climate change and assessing risks from climate change on impact investments, and impact investing in Africa at the time of the pandemic. We have an excellent panel today. I will introduce the moderator, who is Kwame Marfo. Kwame is chairman of the board for the Business Center for New Americans. They put immigrants and refugees on the path to self-sufficiency through a combination of lending programs and support programs as well. Kwame is also a member of the board of Impact Capital Forum, the host of this conference. He is a social entrepreneur in the areas of real estate, agriculture, technology, and media. And he has put together a really wonderful panel that we'll hear from in a minute.
Thank you, Scott, for the kind words. Our topic today could not come at a more opportune time. Our city is in the eye of the storm, and businesses are reeling, particularly those in low-income, underprivileged communities. The prognosis does not look particularly great, and it looks like it is probably going to get worse before it gets better. Today's topic would examine the state of affairs, the impact of the crises on businesses. To my mind, I think one of the best kept secrets in the impact investment community is the role and diversity of community development financial providers working across the spectrum, either as capital providers, either as intermediaries, and also ordering other in-kind support. We are privileged on this webinar to have speakers across the spectrum who would be sharing their experiences with us. And also in forum of this nature, we typically tend to hear from capital providers, not so much from businesses who are actually doing the work. To my mind, I believe there is no impact investing without the businesses in which they invest in. To this end, we are also privileged to have one of the more dynamic women entrepreneurs in New York City joining this panel. Our agenda today will cover a range of topics as discussed previously. The first half of this discussion would be me asking the panelists a series of questions, and at the bottom of the hour, I would open it up to the audience for Q&A. So as Scott mentioned earlier, there's a Q&A function at the bottom. Feel free to post the questions, and I would make sure they get relayed to the panelists. To introduce the speakers, our first speaker is Rabbi David Rosenn. He is the current CEO of the Hebrew Free Loan Society, which provides $20 million in interest-free loans designed to increase financial resilience and economic opportunity for low-income New Yorkers of all backgrounds. Before joining the HFLS, David served as Executive Vice President of the New Israel Fund. Previously, he was the founder and Executive Director of Avoda, which is a Jewish service corp, a year-long full-time anti-poverty program with sites in New York, Chicago, New Orleans, and Washington, D.C. Our next speaker is Cathi Kim. Cathi is the director of Inclusiv Capital. Inclusiv is a national community development financial institution intermediary that also helps low-income and underserved communities achieve financial independence through community development credit unions. Inclusiv provides capital, advocacy, capacity building resources, and innovative products and services to CDCUs. Cathi manages Inclusiv Capital, which has invested over $180 million with partners across several industries, not least including philanthropy, religious, public and private sectors. And not the least, entrepreneur on the panel, Jamila Issah Zomah is a founder and CEO of Africa Dishout, a culture-focused meal and grocery delivery company that connects locals with authentic restaurants. African Dishout has completed over 40,000 individual deliveries since the company started in 2018. Prior to becoming an entrepreneur, Jamila spent 8 years in institutional, corporate, and retail banking and sales in the United States at Bank of Wells Fargo and also in Ghana at Fidelity Bank. Now, so in the interest of time, I'm going to jump right into the questions. So your sense of how the current crisis is impacting the businesses and individuals that you serve. What are you hearing from them?
Right. Kwame, thank you so much. Like Kwame said, African Dishout, we are a culture-based, culture-focused meal and delivery service and we provide basically delivery service for local African restaurants and grocery markets. And since the pandemic, so as a company, African Dishout, we have lost about 30% of our restaurant partners. But as a company, we have actually grown in revenue. And this is because back in December, we partnered with some grocery markets. And I mean, because of all this that is happening, there's been an increase in our demand. But particularly today, I wanted to really focus on speaking much about how this has affected our restaurant partners and how the impact has been on them. So as we know, generally, the restaurant industry, they operate under really low margins. So when the mandate was issued to limit all their operations and all their businesses to takeouts and delivery, to most of them, it was like a death sentence for an industry that employs over 15 million workers. You know, the economic impact, it's enormous. You know, think about the entire supply chain, from the farmers to the truckers, to the cleaners, to the dishwashers, the cooks. You know, it's crazy how central this industry and significant it is to the economy. So it cannot fail. So for those that have closed, I mean, it's mainly because they cannot financially afford to keep their doors open. And for those that have actually remained open, you know, they are just trying to get whatever form of income to keep people on and just to really survive. So I think for small businesses, especially in the community that I come from, and being that most of them are independent operators, you know, they are regular moms that have immigrated from back home and they're just trying to make a living. So I think that this is going to be very hard to survive unless there's actually a proper support and they get it very fast.
That's very helpful, Jamila. David, as a community development nonprofit lender, it seems to me that the organization is, if you will, tailored measured to deal with crises of this nature. Can you shed some light on some of the various relief programs that you've implemented to help the businesses and individuals you support deal with the current crises?
Sure. I don't think anyone is tailor-made to deal with something like this, but we are doing the best that we can. For people not familiar with Hebrew Free Loan Society, we've been in New York for a long time. We've been here for 128 years. We were founded by immigrants in 1892. to help other immigrants basically get a leg up in New York as they built their small businesses. The very first loans that we made were all what I guess we would call now micro enterprise loans, mostly to peddlers selling things off of push carts. And these days we do about $20 million in lending across a pretty wide variety of consumer loans and small business loans. We make student loans, general needs loans, loans for people going to vocational training courses. Our focus is on helping people stabilize their financial lives and access financial opportunity. About 10% of our lending is in the area of small businesses. And so last year, we did about $1.6 million to around 50-something small business owners. This year, it'll be more like 2 million out of our 20 million. The average size of our loan is about 30,000. There's a range of 25 to 50,000, and the terms are usually 2 to 5 years. The interest rate is 0, which makes us unique among lenders in the city. We focus on people who are unbankable, and by what we mean by that is just that usually banks won't lend to businesses until they have a track record of 2 years of profitability. So we're often at the very beginning, not necessarily at the startup phase, but very often in the early phase of a business. And our aim is to help the businesses grow to the point where they can access SBA loans or commercial loans. And we see our job as helping them to get there. So a lot of the businesses now are either shut down because they could not find a way to continue to operate under the current circumstances, or they are barely running, scraping by, trying to make sure that they continue to operate until whatever the other side of this looks like. And then there are some businesses who actually, like Jamila was describing with her business, they found that this is an atmosphere in which their business model is flourishing and growing. And part of the problem is that they have a really hard time accessing growth capital and working capital to deal with the growth needs. So we're doing as much lending as we can. We're seeing ourselves as a sort of a bridge between some of the government programs that are being offered. But as you know, it's been extremely frustrating for small business owners to try to access the Paycheck Protection Program or the EIDL program, or New York City at the very beginning offered a grants and loans program, and then it sort of disappeared. So some people are able to access that, but really it's what we're seeing, it's a very tough time. And especially a very tough time for people who don't have previous relationships with financial institutions, which means that communities of color and lower income communities are going to have the worst time, which is, I'm going to try to segue into Cathi, why CDFIs are playing such an incredibly important role and should play more of a role in ensuring that small businesses either can hang on or can rebuild after this is over.
Thank you, David. Those are very helpful. Cathi, David had mentioned a number of various initiatives from the public sector, EIDL, PPP. I've been having quite a bit of conversations with a number of businesses like Jamila, and there is quite a bit of confusion as to what these programs offer. Would you be kind enough to help educate members of the audience what these different programs are, and also what you're seeing in the market that CDFIs, CDCUs can do to the extent that these programs are not very efficient and efficient, what CDFIs and CDCUs can do to help support businesses like Jamila's?
Great, absolutely. I'll take the first question first. And Kwame, you are not alone. I think even folks at the SBA were confused, not because of the lack of trying, but because a lot of these programs are new. In the first, or phase 3 of the stimulus bill, the CARES Act, we heard something called PPP, which stands for Paycheck Protection Program. There are 4 different SBA initiatives included in the CARES Act, but I'll focus on the 2 that Kwame mentioned, which a lot of folks have been really hopeful for, but also struggling to better understand in terms of how to access these funds to help small businesses sustain themselves during these challenging times. One is the Paycheck Protection Program, which is a new program that offered forgivable loans to small businesses with employees less than 500 employees. Therefore, supposed to help with payroll and either maintaining or rehiring staff at these small businesses. What happened and what we saw with the first phase of this program was that they were building this plane as they were flying it. SBA in general does about $30 billion in these small business guarantees, but with the CARES Act and the Paycheck Protection Program, they're increasing originations 10x in a very, very short period of time. So that's one phase. The other program is called EIDL, or the Economic Injury Disaster Loan Program, which has been in existence. These are also loans to help small businesses in times of crises, but these loans are not forgivable. They're supposed to be repaid, but there's a more longer sort of repayment period. Another feature to the EIDL programs is something called the advance, which is pretty much a grant of up to $10,000, but given the high demand, the SBA kind of refined the programmatic guidelines around that, where it's up to $1,000 per employee. And so kind of taking a step back,
that is right.
Some of the challenges and the roles that David and the Hebrew Free Loan Society have been playing is the same that we've been playing here at Inclusiv, as well as the national network of CDFIs, and being that bridge and that connector. We know that even before COVID, that there are a lot of gaps within the system when we look at those that are low income and economically vulnerable, and then also especially in communities of color. These challenges are not new. More than 40% of all US households were economically insecure even before COVID. And what we're seeing now is that these pre-existing conditions and the racialized systems and the disproportionate sort of impact on low income and communities of color is resulting in a higher level of unemployment. Among communities of color, we're seeing that 65% of those that are filing for unemployment are actually people of color. And so there's this need for very targeted programs, lending, and resources that are designed to meet these needs. And we know that CDFIs and the history of the industry and the movement, and also Inclusiv, has been grounded on focus on serving the underserved and economic development and asset building in these disinvested communities. And so as the CDFI industry as a whole, we've been really kind of hitting the ground running. It's been all hands on deck at Inclusiv, and I'm just so proud of our team and honored to work with our network of CDCUs who, even before COVID times, were providing over $90 billion in loans to these under-resourced and underserved communities. And what we're seeing now, even with the challenges of some of the implementation, the operationalization of programs like PPP, is that we're still getting the data and we're still getting these stories, but we've seen more than $200 million in PPP loans being connected to small businesses like Jamila's through CDCUs throughout the country, and also here specifically in New York. In terms of what we're seeing in the CDFI industry, and what we're sort of advocating and lobbying for, this is what we were designed for. And we know, even from looking at the last economic down cycle during the Great Recession, given our model and just really the huge role and impact mission has on our ability to build resilience in our communities, is that this is also where our mission comes in hand and where we thrive. What we saw in the last economic down cycle during the Great Recession is that afterwards, CDFI credit unions that participated in the Community Development Capital Initiative that was led by the Treasury Program. It was also known as TARP 2. We actually leveraged that capital 60 times within the community in terms of lending directly to low income and communities of color. So we know that this is not just a nice idea, this is a proven model and success story for the social enterprise and mission-driven finance movement, and really what we're lobbying for on behalf of CDFIs, what we've been doing in terms of just making sure that the community development credit unions we're working with have the connections and the resources they need to do what they do best, is being that connector, organizing town halls and meetings with the SBA and the IRS to walk through these programs so that the CDCUs, who are community controlled and led financial institutions, are able to be that connector and leverage these resources directly to bring the capital to those who need it the most. We've also been advocating strongly for set-aside appropriations within these PPP and CARES Act funding, specifically set-aside funds for minority-designated institutions and CDFIs. Some of the questions and the challenges that came about in the last phase or the initial distribution of the Paycheck Protection Program was, where's the money going to, and really why we've been advocating so strongly for these set-aside funds that are earmarked for vulnerable communities. In addition to that, we've also been lobbying for additional equity, $1 billion specifically for community development financial institutions, so we can be flexible and really responsive to the community needs. And again, as I mentioned earlier, we know that this is a successful model because we've seen this happen in other times of crisis during Hurricane Katrina and also during the Great Recession.
Thank you, Cathi. Next question is for Jamila. Jamila, as a woman, as a minority, as a Muslim entrepreneur, I would imagine your experiences in the space has been quite unique. It'll be helpful to get a sense of how your ability to tap into credit, if you will, has evolved over your journey as an entrepreneur. And also, Cathi did talk about a number of various government initiatives that I would hope
Sure. So, I mean, Kwame,
designed for businesses. Like, can you experience?
Right. So, Kwame, we all know our community, it's really underserved, and I would just tell you my side of the story from African Dishout. Even as a thriving company in this whole pandemic, it's been very challenging. I mean, we have the traction, we have the numbers, we have the revenue, but it's not easily accessible, And I would speak briefly also about these restaurant partners that we work with. So, for most minority businesses, getting access to funding, let alone strategic advices to get to help them grow their businesses, it's difficult. So, and basically it's because that we don't have a good way of keeping records of our businesses and, putting in place the right documentation. And so what is happening now on the ground, it's that most of these business owners, they're relying on local business centers and CPAs, calling them here and there because the whole process, it's very cumbersome for them. They turn to their local banks and they're turned away because one, it's either maybe they don't have any existing, relationship with them. And so they're just confused as to which direction to go to. I spoke to one one of our restaurant owners who had cut down his hours of operations. And I was trying to ask him, what is really going on with him? And he explained to me that, Jamila, listen, I have right now, I'm actually doing two full-time jobs just to keep my staff, and keep the restaurant open. So these are the real challenges that these companies are facing. So it's just difficult. And I feel like this is where the CDFIs can really, they play a big role in our community. They fully understand the needs of these small businesses. They can serve them better. They overlook credit score, so I feel like some of these things, some of these programs in place, and like David said, the New York programs that were introduced in the earlier part of COVID, it went away. I personally sent some of these resources to our partners, and they could not access any of these funds. So I feel like it's very important. We all witnessed the fiasco that happened with Shake Shack. These are businesses, these are money meant for the really true small businesses. But here we are, everyone it's trying to grab as much as they can. And the ones that are really vulnerable, they're left at the bottom line. And I personally think that not until something drastic it's done, it's going to be hard for them to survive this pandemic.
Thank you, Jamila. We have gotten to the about hour, so I'm going to ask one more question, and I will open it out to the audience to ask questions to the panelists. David, this is a question for you, which at BCNA, which is the CDFI that I'm a part of, has also put with. When the COVID hit, we were faced with a stark choice, whether to continue to lend to businesses or pull back and tighten underwriting standards, as we know a number of businesses would probably struggle to pay existing loans. So we eventually made a conscious decision that it was imperative, if it were almost ability to continue to support them at a time of need. But now that we've made the loans, there's a question of how do we ensure we do get paid back? So David, it'll be helpful to kind of get a sense as to how your organization anticipate the current crises playing out over the next couple of months, and what instruments are you putting in place to ensure that the loans you lend to businesses, you do eventually recover them?
Yeah, that is obviously a very important question for everybody doing lending in the current environment. And I want to say it's an even sharper question for us, because one of the decisions that we made was not only to continue lending, but to also allow current borrowers who are repaying our loans to pause on their. The first time we announced a pause of 2 months, and we just went back out again and said it's going to be another 2 months, because people really don't have their regular sources of income. And so rather than us taking $250 or $500 out of their bank account every month, as we would to collect repayments, we thought better to keep it with them, let people cover their basic needs, and we will absorb the hit. So when we absorb a hit, it means, among other things, that we don't collect repayments, which we use to support new lending. Most of our new lending happens with money that comes in from repayments on current loans. So the only answer to this was to try to identify any money that we had in our reserves, and to go out and try to capitalize at a level that would allow us to simultaneously pause on collecting repayments and do new lending. And I don't know for how long we're going to be able to do this, but this is currently what we're doing. We, within, I think in mid-March, put out a streamlined version of our general needs loan called the Coronavirus Financial Impact Loan. And we have done, we got about over $1 million of requests in $5,000 increments for these loans. So we are continuing to process as quickly as we can what are essentially safety net loans for people. Your question about credit risk is on our minds, and I think that for us, because we are a nonprofit, and we don't have shareholders that we need to be accountable to turn the money fast and to make a profit, because we're not making any profit. Our interest rate is 0. And so what we'll do with borrowers who run into trouble as they try to reintegrate into the economy when the economy opens is that we will modify their loan payments, and we will work with them to try to get to the point where they don't default. I should say that all of our loans are secured by guarantors. We don't do lending based on credit scores. We don't take collateral. It's all about people in communities standing up for each other and saying, you know, if this person doesn't pay off their loan, I'll pay off their loan. So we do have some recourse beyond the borrower. We can go to the guarantor, but our guarantors are basically the neighbors of our borrowers. And so, you know, this is going to be an issue for us as we move forward, trying to figure out how to provide the kind of runway that people need, but also do that at a rate that allows us to capitalize and sustain the lending as we manage our current loans.
Kwame, can I add on to what
Thank
David
you
was
very much. Absolutely, Cathi.
Yeah, just to kind of take a step back and from like a systems level, our CDCs are using a similar sort of approach where, you know, we don't see these loans as just a financial transaction. It's about really making a difference in that community. And so the approach that CDFIs and CDCUs use are to couple the financial services also with development services such as financial counseling. And it's the overall relationship you have with your member or the small business in your community. And what we've seen is, yes, it's a challenging time. There may be increases in delinquencies and some net charge-offs as well. But what we've seen in previous economic cycles is that you can do well by doing good. We came out stronger after the Great Recession, and we stand by that. And like David, what we've been doing at Inclusiv is just really spending a lot of our time reaching out to our members to see how their communities are doing, but also what their capital needs might be, and just kind of coming up with our own COVID relief fund and bringing together impact investors, ranging in different types of, you know, ways that they can invest in direct COVID relief, from helping provide liquidity for the PPP loans to that sort of mid to longer term sort of path to recovery through equity investments in community development credit unions. Likewise, you know, the Hebrew Free Loan Society and BCNA have been here for decades, and we know that having this social enterprise model where, you know, mission comes first really can take us a long way and make our community stronger.
Thanks for that insight, Cathi. We're still open for questions for the audience. So if you do have any question, please don't hesitate and type in it in the Q box, and I'll be happy to pose it to the panelists. A question for either Cathi or David. In terms of the impact on capital providers, I would imagine there's been quite a bit of demand for capital. So we'd like to get a sense of how you're getting capitalized, and also from an operational perspective, keep with increased demand for the products and services and offerings.
Sure, I can go first on that. We have a lot of philanthropic partners, and in the years prior to all of this, we have been trying to develop relationships with people who hold cash for various purposes, including just diversifying their portfolio, and convincing them that they should be indifferent to where that cash sits. In fact, it could sit with us, and it would do a lot of good out there in the city. And we can guarantee, because I didn't mention this before, the Hebrew Free Loan Society historically has had a 99.9% repayment rate. So we feel pretty confident that if we borrow money, we're going to get back from our borrowers. Now, I should say we're not really that confident about what's going to happen in the next period, but prior to all of this, we were confident borrowing at 0% and promising capital preservation. So and promising not only capital preservation but also social impact. So we made an impact investment pitch to philanthropic partners and to high net worth individuals who had sufficient cash holdings so that they were able to make loans to us for a period of 2 to 5 years at 0%, allowing us to have a cost of capital that was appropriate to the interest rate that we charge, which is 0%. So we closed a bunch of those loans actually just at the end of last year, and it put us in a very strong position to come into the pandemic. And that was one of the things that made it easier for us to decide to hold up on collecting repayments, because we did have some capital stored up from these partners, and we have been successful in raising about $4 million since the beginning of all of this. That is targeted toward the coronavirus financial impact loans that we're making. I put into the chat a little bit of information about those loans. And so I'm hopeful that if there's another several months where we need to continue to do a combination of lending and thinking differently about repayments, that we'll be able to continue to raise capital from people who are interested in seeing social return and aren't insisting on a financial return at the same time.
That was very helpful. We do have 2 questions from the audience. The first one comes from Vicente. So Vicente would like to know how, I guess this question is for Cathi. You'd like to know, how do sole proprietors and partnerships fit into the funding structures? The PPP requires employees and EIDL scale with number of employees. Is there any option? So I guess the question is, how do partnerships and sole proprietors navigate the cumbersome offerings within PPP and EIDL? And also, if there are any other resources that you think they can tap into, would love for you to shed some light on that.
Sure. And again, I don't work for the SBA, but I am happy to share what we've learned through our engagements with them and from our credit unions. If you have employees less than 500, right, you can apply. We know independent contractors can also apply for PPP as well as the EIDL loans. You would use a different type of documentation for some of the sort of document requirements that you need. For example, you could use a Schedule C instead of like pay stubs or like your payroll statements. So I don't know if that was helpful. And then with the EIDL loans, you can apply directly to SBA. That's one key distinction between the 2 programs. Businesses can apply for both PPP and EIDL loans. But the EIDL loans, you apply directly through the SBA platform, and PPP, you must go to a lender, which includes CDFIs and CDCUs, and you could find one through the SBA website. You can also reach out to me. I'd be happy to share the directory of CDCUs in our network. In terms of other resources, Jamila also shared that she had tried some of the local New York City, and New York State has a few small business initiatives as well. So you could check those out, and also encourage you to check out your local community development credit union. We have small business loan programs in addition to PPP. We've been lending to micro enterprises and to different types of businesses in our community. So I would encourage you to do that as well. And again, feel free to reach out to me, and I could share a link to our website, and you could find a community development credit union.
Thank you very much. The next question comes from John Myers. John is the current board chair of the Impact Capital Forum. So his question is, well, it goes to the 99% payback rate that David mentioned, which for nonprofit, that is actually looks better than some of the more commercial lenders are doing.
So my answer
the
to
first
this,
question.
Oh, sorry, go ahead.
Right, no, it's just 2 questions. One is obviously to shed some light on what's driving these payback rates, and 2, for you and Cathi, the big services or mentoring do you provide besides financial capital?
Okay, the 99.9% repayment rate is, I'm convinced, pretty much entirely due to the fact that our way of securing the loans involves getting people who the borrower knows personally to guarantee these loans. So it's usually like your in-laws or your next door neighbor or your coworker. And there is a huge amount of motivation for people. Well, first of all, people do generally want to, pay back their debts. And especially when they're borrowing from a nonprofit organization that they know has a public purpose mission. But really what they don't want to do is wind up with Uncle Fred at Thanksgiving dinner and that uncle had to pay off their loan. That's very, very awkward. And if you could avoid that at all, I mean, obviously sometimes circumstances overtake people and they have to default. But generally, our borrowers try really hard not to leave their guarantors in the lurch. And we're also a very friendly lender. So if somebody in the middle of repaying a loan loses a job and calls us and says, I need to take down my repayment to, $50 for the next 2 months while I find a new job, we'll work with them and make sure that that happens. So I think that's what accounts for our incredibly high repayment rate. And when private lenders say to me that the reason that they need to charge so much to lend to lower income people is because they have to price in the risk, I smile to myself and I say to them, we've been around for 128 years lending to lower income people, and we have figured out a way to lend without, having to price in risk. You can price in profit, it's fine. I mean, I'm all for the profit-making system, but in our particular area where we're trying to be a resource for lower income people, it seems like if you can figure out another way of dealing with the risk, aside from putting it into the price of the loan for people who really can't afford that price, then we should try to do that. And that's what the CDFI sector is all about.
Yeah, to add on to what David said on a macro level, we're seeing similar things in our analysis of the community development credit union industry. Our research and data team do a fantastic job in putting together this annual report called the Inclusiv Finance Report, where they look at the financial trends between mainstream credit unions and those that have that community development model. And what we've seen time and time again is that those that have that community development mission, they're outpacing the mainstream industry in terms of growth. And also they're going deeper into the market, into the low income and vulnerable communities. And you know what, their charge-offs are actually on par, if not better. We also have a median net charge-off ratio of less than 1%. And so it's not who your lender's risking anything, but how you're managing the risk and also understanding your larger business and impact model.
That's very helpful. There is a related question, and which I guess can answer, but directly to David. So this is a question from Jason, and Jason wanted to, I think, David, you kind of alluded to it. He wants to understand how HFLC ensures that repayment is assured. Is it through the quality of the business, or is it the assistance that you provide in addition to the loan?
Right. So one thing I'll say about the process of getting a loan from us is that we have professionals who work with borrowers on their application to make sure that their business model is solid. And so we send them to the Small Business Center in New York to do a full cash flow and a business plan. We really want to make sure that businesses have, nobody has a crystal ball. We don't know if the business is going to succeed. But the last thing that we want to do as a lender is to lend into a model that is shaky, have the person take on debt, have the business fail, and then they have no source of revenue and plus debt. So that's not a service that we would provide to them. That would not be good. So we have a fairly rigorous vetting process before we're going to make loans, and we have a committee that approves the loans. That the committee members are all people who have expertise and experience in small business, and so very often they will provide advice and guidance to the small business owners as they're going through the process on various aspects of the business. But in terms of repayment, again, it's the guarantor factor that I think ensures the repayment. And even when businesses fail with us, we still have almost no write-offs. I mean, people do repay their loans, we have to modify them, and they don't pay at the same rate as they would have if they, continue to have a surviving and thriving business. But, people are incredibly good about repaying even if their business fails.
That is incredible to hear. The next question comes from Brian, and Brian would like to know how the CDFI fund through Treasury, what is the funding like this year compared to last year? Would you guys have any insight?
Yeah, well, as I mentioned, right now, what the CDFI industry and leaders are asking for, in addition to the annual sort of appropriations, is $1 billion in additional emergency stimulus funding to help directly with COVID response and recovery initiatives. I believe last year the appropriations was actually increased. I think it's over $250 million, and that's in a combination of financial assistance and technical assistance awards. There are also, other folks on the line may be familiar with some other types of capital that's available through the Capital Magnet Fund, the Healthy Food Financing Initiative, as well as New Markets tax credits. But for the FANTA awards, for the credit unions, banks, loan funds, and depository holding companies, it's about 250 million in excess of that. Yeah.
Right. Next question comes from Mark. So Mark wants to know what are some non-financial ways to support CDFIs, and to that question, what are the greatest operational and programmatic needs? I think Mark might be in a position to help.
Well, I would say that one of the things for us is we're always in a dance between wanting to raise our profile so that people know about us and can access our loans, and worrying that if too many people come all at once, we're going to run out of money for the lending. So we try as much as we can to keep those two things running on an equal level. But I will say that it's New York. It's very, very difficult for lower income people to find sources of financing. And so one of the ways that I think you could help all of the community development financial institutions is just to talk about them, is just to make sure that that small business owners and entrepreneurs know that they have an alternative to online lenders or tapping yet again an already tapped out network of friends and family. There are institutions like mine and the ones that Cathi represents that have a mission of trying to capitalize businesses that are being started and run by lower income people in the city. So that would be an enormous help of just spreading the word. Cathi, do you have any other ideas? Or Jamila?
No, absolutely. Last year we celebrated the 25th anniversary of the CDFI movement. CDFI Fund was created under the Clinton administration, and as Kwame mentioned, they're still known as the best kept secret, but we shouldn't be a secret. We represent over hundreds of billions of dollars in community controlled assets. We're full service financial institutions, and really one easy way for you all to get connected. We have a national directory of community development credit unions. Check them out, they're on our website. Open an account, get a loan from them, and also, as David mentioned, share a story. We're also working on advocacy right now for the direct appropriations for the CDFI fund to support community lending, especially in vulnerable communities during this time.
That's very helpful. So this is a related question, and to both of your points that CDFIs and other community-based lenders shouldn't be a secret. But I guess the flip side of it, people like Jamila, because I've been talking to her for quite some time in terms of accessing credit, there is a lack of knowledge and understanding on how the process works. So there's a question from Mahinen. Mahinen would like to know, what is the approval process and due diligence for loan applications? And that goes to both Cathi and David, and I think it'll be a question that Jamila will find very helpful.
Yeah.
Jamila probably knows it from the applicant side. But I don't want to go through the entire due diligence process, except to say that we try very hard to make sure that people have a solid business plan. We actually send all of our borrowers to a partner called Green Path for credit counseling to make sure that they understand a little bit more about what credit options are available to them and how to responsibly use credit, because usually we are not the only source of capitalization for these businesses. I want to make sure that they have some knowledge of what are the upsides and the potential downsides of various offers out there. I think there was also a question about just the cost of our making these loans. And I'll just say for my organization, we have about a $2 million budget. We made $20 million of loans this year. We serviced an additional, I don't know, $10 million of loans. So somewhere in the 5 to 10% range is the cost of our making these loans. I don't know, Cathi, can you say how that compares to the operating cost ratios for other CDFIs?
Yeah, well, I can speak to community development credit unions, and there is a range, but on average, depending on asset size, OpEx of maybe 5%, around there.
That's very helpful.
Yeah.
There is I guess a note from Robin, and he points out to a website, my C note, C as in Charlie note.com, and he does indicate that this is a great tool that supports CDFI. So this is more of an FYI. We are getting to the top of the hour, so I'm gonna have you all give us some words of hope. In this current stressful times. Go ahead.
Sure, I would just add to what David and Cathi said. If you're on this webinar and you're a business owner like myself, please take these, you have to go for these resources. I mean, it's very important we take opportunity of what is available now. You know, we cannot afford to have you close out. We want you to succeed. We want to make sure that you're able to thrive through this whole craziness. So please, and I'm so glad that, and like I said earlier on in my presentation, the CDFIs, they're very, their role, it's very important to our path, and I think that they need the ultimate support to be able to really service us as underserved businesses. And I just want to urge you to really take opportunity of those local resources and make use of them.
That's very cool, Jamila. Final words, David and Cathi.
Cathi, you want to go?
Sure. Yeah, no, thank you so much to Impact Capital Forum for organizing this conversation today. Clearly, there's a lot of interest in how we can make a difference during these challenging times. And I think we're at this point of collective change and metamorphosis. But really, right where we are right now, everyone is challenged. But as we look really on how we can help and build resiliency in vulnerable communities, there are ways to do it in ways that, that were not supported in the previous economic system. So to think about, CDFIs and other ways to engage in impact investing, those opportunities are there, whether it's the Hebrew Free Loan Society investing in CDFIs, but there are very meaningful ways in which you can make a difference with your investments as well in directly investing in underserved communities. So just encourage you all to look out for that and join a CDFI and your local CDCU.
I guess I'll just take the long view from an institution that has been in New York for a really long time, right? We've been in New York through the Spanish flu. We've been in New York through 2 world wars. We've been in New York through recessions, depressions, everything. And the city has figured out a way to rebuild and come back through all of that. So I'm confident that we are going to rebuild and come back through this as well. It is not going to be easy. This isn't a New York specific thing. This is a global pandemic with global economic impacts. But I do hope that hearing from us has informed you a little bit about what's going on to specifically make sure that lower income, less served communities in New York City have access to the resources that they need to get their small businesses through to the other side, or to get their small businesses up and running after all of this is over. You know, half of all people who work in the United States work for a small business. 99% of all enterprises in the United States are small businesses. So this is a huge issue for the overall economy and for the economy of New York City. I just want to thank you for spending time hearing a little bit more from us about how it all works.
On that note, I came into this conversation with a bit of an uneasy feeling, but from hearing from David and Cathi and Jamila, I am optimistic that this soon shall pass, and we working together as businesses, local communities, as capital providers, as advocacy organizations, we would be able to ride this out. So thank you. Special thank you to the speakers, and also to the panelists for joining us on this conversation, and for the lively questions asked. If you do want to get a hold of any of the speakers and want to learn more about their respective organizations, and also Jamila's, please don't hesitate to reach out to the Impact Capital Forum. Contact us on the website, or feel free to email me, Kwame, kmarfo@gmail.com, and I'll be happy and glad to coordinate and connect you to the right people. On that note, thank you all for giving us a very productive use of your time, and look forward to seeing you at future events. All right, bye-bye.
Thank you.
Bye.